All right, let's dive in. Today, we're pulling back the curtain on one of India's biggest and most popular mutual funds, the ICICI Prudential Balanced Advantage Fund. We're going to figure out what really makes it tick.
So let me ask you something. Are you just exhausted from that constant worry, that little voice in your head asking, is now the right time to buy? Should I be selling? We've all been there, right? Watching our money go on a wild ride every time the market gets a little shaky. It's the classic investor's nightmare, trying to perfectly time the market, which, let's be real, is a game that's nearly impossible to win.
But what if there was a way to just take all that emotional guesswork out of the picture? What if a fund could be designed to make those tough calls for you, so you can actually get a good night's sleep? Well, that is exactly the promise behind the fund we're digging into today.
So, first things first, what in the world is a Balanced Advantage Fund, or BAF, as you'll often hear it called? You can think of it as a special kind of fund, one that's built on a really smart, almost common sense idea. The secret sauce here is a strategy called dynamic asset allocation. Now, that sounds fancy, but all it really means is that the fund is not just sitting there. It's alive, it's constantly and automatically tweaking its investments, moving money between riskier stocks and safer debt, all based on the answer to one simple question. Does the market look expensive right now, or does it look cheap?
And that's exactly why people love to call it an all-weather fund. It's built to have its umbrella ready when the market storms hit, but it's also ready to put on its sunglasses and enjoy the sunshine when the markets are doing great. It's all about being prepared no matter the season.
But how does it actually do that? I mean, what's the mechanism inside the fund that tells it, okay, time to get defensive, or all right, let's go on the offense? Let's pop the hood and take a look. Okay, this slide right here perfectly explains the simple genius of it all. Just picture a seesaw. When the market is flying high and valuations are expensive, the fund is programmed to automatically sell some of those stocks, locking in profits and park that cash in the safety of debt. But then, and this is the best part, when the market tanks and everyone else is panicking, the fund does the total opposite. It leans into that fear and starts buying up great stocks on the cheap. It's pure automated discipline. And let me tell you, this strategy has earned an unbelievable amount of trust. We are talking about more than 70,000 crore rupees under management. Now, that number isn't just about being big. It's a massive vote of confidence from thousands and thousands of investors just like you. And the ICICI BAF isn't some new kid on the block. It's been running this playbook since way back in 2006, which makes it one of the original pioneers in this space. And it's not just guessing. It uses a proven, data-driven model based on price-to-book value to make these decisions. This is so important because it takes human emotion, fear and greed, completely out of the equation.
So it's really smart about managing risk. That alone is a huge win. But there is another feature, one that's kind of hidden, that is an absolute game changer for a lot of people. Let's talk about its incredibly clever tax secret. Here's the dream, right? You want the stability and lower risk of a debt fund, especially when markets feel a little crazy, but you also want the much, much friendlier tax treatment of an equity fund. So how on earth can you get both at the same time? Okay, now this is where it gets really clever. Even when the fund manager is pulling money out of stocks to protect your investment, the fund is structured in such a way that it legally maintains its status as an equity-oriented fund. So as far as the tax man is concerned, it's still an equity fund. It pulls this off by using some smart financial tools like derivatives to basically hedge its position. Think of it this way. Even if only 30% of your money is actually in the stock market, these tools allow the fund to maintain a gross equity exposure above that magic number of 65%. It's a bit technical, but the result is incredibly powerful and saves you a ton of money.
So what does this actually mean for your wallet? Well, if you hold on to your investment for less than a year, your profits are taxed at 20%. But here's the number that matters. If you hold it for more than 1 year, the tax on your long-term gains plummets to just 12.5%. And hang on, here's a pro tip that makes this deal even sweeter. Every single financial year, the first 1.25 lakh rupees of your total long-term capital gains from equity is completely tax-free. That's a huge saving right there. I mean, this chart just says it all, doesn't it? When you compare it to a normal debt fund, where your gains could be taxed at your income slab, often 30% or even more, that 12.5% rate is a massive, massive difference. That means more of your hard-earned money stays right where it belongs, in your pocket, working for you.
Okay, so we've covered the how and the why. Now we get to the most important question of all. Is this the right fund for you? Let's break down who this is really designed for. This fund could be a fantastic fit if you consider yourself a pretty conservative investor. Someone who wants that market growth, but just can't stomach those heart-stopping drops. It's also a wonderful, simple starting point if you're brand new to investing. And for retirees, using a systematic withdrawal plan from a fund like this can create a really steady and very tax-friendly stream of income. But before you get started, there's one last crucial detail you have to keep in mind, and that's the exit load. Typically, if you need to take your money out within the first year, you're going to face a 1% penalty. This fund is really built for patience and for the long haul, not for quick in-and-out trading.
So when you boil it all down, what's the big takeaway here? The ICICI Balanced Advantage Fund offers a pretty compelling deal. Look, it's not built to hit home runs when the market is soaring. Its real superpower is protecting your money when things get rough and delivering steadier, less stressful growth over time. The real question it leaves you with is this: what do you value more on your investment journey? That automated stability, or do you prefer the hands-on control of doing it all yourself? That's a great question to reflect on for your own financial future.